So your next reading is Understanding Income Statements, a quick overview, and these are all your learning outcome statements within this reading. So we will go through each one of them one by one. Alright, the first LOS says, describe the components of income statement and alternative presentation formats of that statement. First of all, income statement is referred to as profit and loss account. That's the term we have been reading in our elementary accounting. It is also sometimes called statement of earnings, statement of operations, or simple profit and loss account. So we need to describe the components of income statement. These are the components of income statement. One by one. Revenues. Revenues is what firm receives by selling goods and services in its normal course of business. Just we call it sales as well. When you say net revenues, it means sales minus returns or allowance for returns. Fine. Expenses. These are spendings by the businesses, outflows of cash, reduction in the value of assets, incomes of liabilities in our normal course of business. Selling and administration expenses, repair and maintenance, advertisement, etc. There are so many long list of expenses. Then gains and losses. Now what's the difference between revenue and gain, expenses and losses? Revenue are central from ongoing operations, whereas gain are also in a way revenues, but they are not central. They are peripheral, or they arise from incidental transactions like gain on disposal, or maybe rent received on company's property that has been rented out. Likewise, expenses are recurring. We keep on incurring expenses, whereas losses, they are from those transactions that are peripheral or incidental. They're not from the main ongoing operations of the business. So that's the main difference between revenue and gains and expenses and losses. So when we say net income is the net of all these revenues minus ordinary expenses plus other incomes minus other expenses plus gains and minus losses. So this is a simplified version of your income statement. So what are the presentation formats? There are two presentation formats. One is the single step format. A single step format, as you can see, it just lists all the expenses in one go, all revenues grouped together, and all expenses grouped together. All revenues, all expenses, and net income can be calculated in just a single step. Well, looks good, simple, but unfortunately, this gives very little information for us, for accountants, for analysts to work or to analyze the company's performance. So this could be simpler, but it doesn't have much utility for us. So we have a multi-step format in which we calculate profits at different levels. We calculate our trading profit by deducting CGS from revenue. This gives us gross profit. Then we deduct selling and general administrative expenses, other expenses, to calculate our operating profit. This is the profit where we gauge the performance of a particular divisional manager. Interest expense, income before taxes, certain provisions, and it gives us income from continuing operations. We might have discontinued certain segments during the period. So adjusting those discontinued operations net gains and losses after taxes gives us the net income. So this is a multi-step multi-step income statement, much more meaningful. It has much more relevance for our analysis for the purpose of performance evaluation. Next LOS says, describe the general principles of revenue recognition and accounting standards for revenue recognition. There has been a new standard jointly issued, not jointly issued, it's a converged standard issued by IASB and FASB. It says the core principle under the new revenue recognition standard is that revenue should be recognized for the promised goods or services to the customer for amount to which entity expects to be entitled. First, under the US GAAP, the revenue recognition was comparatively simple. You just have to meet two conditions. Revenue must be earned, or it must be received in form of cash or claims to cash. But now the new standard has 5 steps. The first step says identify the contract with the customer, who your customer is, with whom the transaction for revenue has been entered into. Identify the customer. This is the first step. Once the customer has been identified through whether written on an oral contract, to whom we want to sell our goods or services, the next step is to identify the performance obligation in the contract. What we as a seller expected to do. What goods are we required to deliver? That's the second step. Identify the obligation in the contract. What do we have to do? The third step, determine the transaction price. Now that's very essential. In order to recognize revenue, you have to determine the transaction price. What's the price agreed between the buyer and the seller, between me and you? Once the price has been established, allocate the transaction price to the performance obligation. For example, this is what I have to perform, and it has multiple subparts to it. The total contract price is $100,000. Now, how do I split this revenue in these three different segments? And how do I compare these specific revenue streams with the cost? This is what we call the allocation of the transaction price to the performance obligation. It is studied in much finer detail in CPA and CMA, and luckily we won't be going to that extent where we'll go deeper and deeper, and we don't need to. Just these 5 steps we need to know. Otherwise, had it been CMA or CPA, would have, because all these slides I've extracted from my CMA course, so we would have gone much deeper. We don't need to. Inch deep, miles long. That's the idea. So allocate the transaction price to the performance obligation, and finally, recognize revenue when or as performance obligation is satisfied. So these 5 steps are to be completed before the revenue could be recognized, and you just need to generally remember these 5 steps and it would be sufficient. Next, I think we are in the same reading, specific revenue recognition application. In some cases, revenue may be recognized even before delivery. Like in mining industries, revenue can be recognized even you have just extracted the minerals from the earth's surface. You have just extracted the minerals and they haven't yet been finalized. Just extraction gives you the right, or what you can say, under the standard, you can recognize revenue. So even the revenue can be recognized before delivery. Of course, after delivery and during delivery, so different stages are to be met. Long-term construction contract. Long-term contracts mean certain projects which will take an extended period of time to complete. So how do we recognize revenue in such a situation where a project will take maybe 5 or 6 years? So what should we do? So under this, we have 2 methods under the US GAAP. One is the percentage of completion method, and other is the completed contract method. Remember, we are first discussing under the US GAAP. Under the percentage of completion method, let's say if in the first year we have completed 20% of the job, how do we calculate the percentage completion? It is calculated by dividing the cost incurred so far divided by the total estimated cost. We will do it in our MCQs. So cost incurred so far divided by the estimated cost. This will give us the level of completion. To the extent we have completed the job, we can recognize revenues and profits accordingly. This is called the percentage of completion method. This is appropriate when the cost and revenues can be reliably estimated. So proportionally, we can calculate our profits as the work is performed. What about the completed contract? Under the completed contract, where we are unable to determine the overall contract cost, in such a situation, US GAAP allows you to use completed contract method. You have a 5 years project, year 1, 2, 3, 4. You will recognize revenue and profits only when the contract is completed. Remember, percentage of completion method is allowed under the IFRS. It is allowed under the US GAAP. But completed contract method, that the revenue will only be recognized once, or profit will only be recognized once the contract is completed. This is allowed only in the US GAAP. It is not allowed under IFRS. Right? So what do we have under IFRS then? Under IFRS, we have percentage of completion method. We will do questions. And the second is the cost recovery. In which you cannot, if the revenue cannot be ascertained or the cost cannot be ascertained, estimated cost. Let's say in the first year, if we have incurred $100,000 cost, the same amount can be recognized as revenue. Next year, we incurred $130,000 cost. $130,000 revenue can be considered. So under IFRS, we have this alternative treatment of construction contract, which for which the cost cannot be estimated. So whatever cost has been incurred, it can be the revenue equal to the cost incurred can be considered as the revenue for the period. Whenever a loss is anticipated, whether under the percentage of completion method, completed contract method, or under the IRS system where you can recognize revenue only to the extent of cost incurred, whenever the loss is expected, the whole loss is recognized in the same period when the expectation of loss is made. That's enough. Next, installment sales. Installment sales, when we have sold goods, but the recovery of cash will be spread over an extended period of time. So we have three alternative treatments. First is the normal revenue recognition. We just treat it as just like a normal revenue, debit our customer and credit sales, and then keep on receiving the amount by debiting bank and crediting the customer. You don't have to go for the debits and credit. That's what our job is as accountants, but you just have to see this application. So under normal revenue recognition, it is treated in the same way as the previous one. Installment method, this is the second alternative. Under the installment method, what we do, let's say we have sold goods to a customer on 3 years contract, and the overall gross profit on this sale has been determined 30% at the start of the contract. Let's say if we received first installment of $100,000, then what is the profit? 30% of the amount received. Next year, we received, let's say 70,000. Maybe the amount was not a single amount or a constant amount every year. So what would be the profit recognized next year? The overall profit is 30%. So 30% of the amount collected, 21,000. So under the installment method, the profit recognized is equal to the cash received multiplied by the profit percentage determined at the start of the contract. Then finally, the third is cost recovery. No profit is recognized until the cost is recovered. Let's say the asset we are discussing, let's say it has a cost of $210,000. We'll keep on collecting the money, debit cash, keep on collecting the money. Once the cost is recovered, any subsequent collection above 210 in the year 2 or 3 will be considered as a profit. This is called cost recovery method. Fine. Next, we are still on the same reading. Barter transaction. Barter transactions, as the term suggests, these are the transactions involving goods for goods, goods for services, services for service, services for goods. So no cash is involved, without involvement of cash. So what do we treat? How do we treat these under the US GAAP and IFRS? Under the US GAAP, revenue can be recognized. For example, we traded goods for goods for about $100,000. This was the fair value of the goods traded. So revenue can be recognized for this amount only if the company has historically been entering into such transactions previously. Right? What about under IFRS? Same amount, same item, fair value is $100,000. So under IFRS, $100,000 revenue can be recognized if the same amount can be considered as revenue with other unrelated parties. So these are the two differences between IFRS and US GAAP. Then gross and net reporting of revenue. Revenue can be reported in two ways. One is gross, that is the normal balance, normal income statement. You have your sales given separately and cost of goods sold, sometimes called just cost of sales. They are given separately. So then you calculate your sales and cost of sales separate. Then you calculate your gross profit. Gross revenue and cost of sales, that helps you calculate gross profit. Under net revenue approach, sales less cost, the net amount is reported. So where do we need to use the gross revenue reporting? It says the gross revenue reporting is required for a seller who is the primary obliger and bears inventory risk. He holds the inventory, he bears credit risk. And he's the one who selects his own sources of supplies, and he's the one who establishes his prices. So in this case, he will have to report under the gross revenue reporting system. Just brief over, you don't need to drill in finer details. Next, new revenue recognition standard, collectability related financial statement disclosure. Under the new revenue recognition standard, companies are required to report, since it has been issued conjointly by FASB and ISB. So under the new revenue recognition standard, companies are required to report different revenue contracts disaggregated into different categories. all contract related assets, that is receivables, contract related liability, that would be payable, must be reported separately. That's what is required under the new standard. Then we have next reading, calculate revenue given information that might influence the choice of revenue recognition method. First idea is the matching principle, revenue versus cost. Matching principle says that your revenue must be matched with the relevant cost. For example, if we have incurred costs in 2020 and revenues earned in 2020, the costs that fall within January 1st, 2020 to 31st of December 2020, if that's your financial year. So the revenues earned from these cutoff dates must be matched with the cost incurred within the cutoff date. Any cost paid for the next year or any cost paid now for the previous period must be separated. In other words, the prepayments and accrual must be adjusted in order to bring the relevant cost for the current period. Prepayments and accruals must be adjusted to match the current year revenue against the cost related to the current period. This is called the matching principle. Expense to generate revenue in the same period is matched against the revenue recognized. When you say the period cost, there are two types of cost. One is product cost, other is called the period cost. Product cost primarily are direct material, direct labor, variable overheads and fixed overhead, which you also call the cost of production under the US GAAP and IFRS. Their capitalized costs become the cost of inventory. When you say the period cost, these are the costs that are incurred and considered as an expense for the period. They are dependent upon the time. But the product costs depend upon whether they are in the inventory or they have been sold out. The product cost, as long as the inventory is with you, it's an asset, current asset, reported in the current asset on the balance sheet. But when these items are sold, these items become CGS, cost of goods sold. So product cost is an asset as long as the inventory is with you. When the goods are sold, it becomes cost, called CGS. When you say period cost, these are the costs that are not capitalized. Rather, they are considered as an expense for the period and they are reported in your normal expenses, operating expenses, selling and administrative expenses, etc. These costs are called period costs. They are not directly related to your production. Next, implication for an analyst, for you people. Some firms resort to aggressive accounting, deliberately delaying expenses, like a certain production manager has been given a discretionary maintenance expense of $2 million. He deliberately delays spending this amount of money so as to reduce the expenses, delay the expenses and make profit look higher. Or recognizing revenue early through channel stuffing. So an analyst needs to be observant that the company might have employed aggressive accounting, deliberately delayed expenses like these, or might have recognized revenue too early. So in such a situation, the analyst should match with the industry peers what the industry competitors are doing. Look for the footnotes, what the company is doing. Next reading is describe general principle of expense recognition, specific expense recognition application and application of expense recognition choices for financial analysis. First of all, expenses by nature. When you name the expense, salary, advertisement, rent, insurance, repair and maintenance, so on and so forth, these are called expenses by nature for what they were incurred. When you say expenses by function, we classify them through selling expenses, administration expenses, cost of production, cost of goods sold. So aggregating expenses through function is called expense by function. Then the cost of long-lived asset must also be matched with the revenue. Let's say an asset that is expected to last 10 years, I cannot wait till 10 years before it goes to zero. I have to split its cost over its estimated life. I have to split its depreciable base over 10 years. I cannot wait till the end of 10 years when the asset goes bust and I incur $10 million loss at the end of the period. I need to split the depreciable base of the asset over its estimated useful life. This is what you call the matching concept. You have generated revenue over the 10 years. So this revenue must be matched with the consumption of the assets over the 10 years period. So depreciation is also as an expense. We have these things and we'll discuss them much more in detail in your long-lived assets. Tangible assets are depreciated. Many methods are there, all coming, lots and lots of questions will be done. So for tangible assets, we use the term depreciation. That is systematic allocation of the depreciable base over the estimated useful life. We split the cost of the asset for as long as it will live. For intangible assets, we have a certain way amortization, discussed in detail, and those natural resources, the mines or quarries, they are in a way depreciated using a method called depletion. We'll do that as well. So what we are doing right now, just letting you know that these are the expenses charged against your revenues. Still the same reading, I guess. Tangible assets are depreciated. The first method is given a straight line method. This is the formula we use for straight line depreciation calculation, cost minus residual value upon useful life. This is also called equal installment method, where the depreciation charge every year is same depreciation charge every year. So this is your original cost. We haven't been given the complete information, so we split the cost in equal basis of the expected life of the asset. So this is called the straight line or equal installment method, where the depreciation charge is same. Where do we use this method? Why do we do? That's not the topic for today. Just remember, depreciation is an expense and straight line is one of the methods to charge the depreciation to your income statement. Next, we have another group of depreciation method called accelerated depreciation method. In accelerated depreciation method, we have been given double declining balance method. Some of you isn't given. This is from my CMS slides. So I've just extracted the relevant part for you. So this is the formula we use for calculating the straight line depreciation. And for double declining method, what is double declining method? Simply you can calculate the double declining balance percentage by dividing 2 with the useful life. Like in the previous case, the life of the asset was 5 years. So 2 upon useful life multiplied by whatever the book value stands in your books. Book value, we know, net book value or the carrying value, it's equal to cost minus accumulated depreciation charge so far. Net book value is equal to cost minus accumulated depreciation. Whatever book value is appearing at the end of the year, that will be multiplied 2 upon 5. This will give you the percentage. The percentage will be calculated by 2 by 5, and this will be charged to the book value every year. So this is how you will calculate the percentage, 2 by 5 multiplied by 100, and that percentage will be multiplied by the book value every year. There are lots and lots of questions for double declining method, calculating depreciation for 3rd year or 5th year, all coming. Just remember, this is one of the ways to charge depreciation, double declining method. It's coming, all coming in your later slides. I mean your later readings. Next, inventory expense recognition. I said inventory is an asset as long as it's in inventory. When the goods are sold, they become expense. Inventory is an asset, a current asset. But when it is sold, this current asset becomes CGS. We debit CGS, credit inventory. You don't have to remember debit, credit. This is what we do. And I have this bad habit of putting entry into everything. So inventory is an asset, but when it's sold, it becomes an expense. So we have 4 specific methods. Specific identification method. This method is used when the firm can specifically identify which item A has what cost, which item B has what cost. So specific identification method is one of the ways to identify or value your inventory and charge cost accordingly to CGS. Then the second method is called FIFO, the first in, first out. There is a separate reading on inventories. FIFO, LIFO, weighted average, specific identification will be done in much more detail. Lots of questions. We'll do the periodic and perpetual method of valuation. Everything is coming. Remember, these are the 4 methods for inventory valuation. So specific identification. FIFO method means first in, first out. The items that are bought first are charged to production first. The items that are bought first are charged to CGS first. This is called first in, first out. It is allowed as per US GAAP, allowed as per IFRS, allowed as per US GAAP, allowed as per IFRS. But this method, LIFO, the last in, first out, the items that are received last are issued first to CGS, or the items that are received last are charged to production. This is only allowed under the US GAAP, and that's one of the differences between IFRS and US GAAP. And that will be discussed in detail in your inventories. And weighted average, when we calculate a single average rate to be applicable over the future periods for the cost and for the inventory valuation purposes. So these are the 4 specific inventory valuation methods which are coming your way as we proceed. We are still on the 4th reading, intangible assets. The assets that do not have the physical existence are called intangible assets, like patents, copyrights. We have the complete accounting coming for you. So intangible assets can be classified into 3 categories. Those with the limited life, those with unlimited life, And goodwill is treated as a separate intangible. Its accounting is totally different from other intangibles. So those intangibles that have finite life or limited life, they are amortized in exactly the same way we depreciate our long-lived assets. We'll discuss in detail. Those intangibles that have unlimited life, like patents that are renewable. Patents that are renewable have unlimited life. They are tested for impairment at least annually. How do we do it? All coming. And goodwill is a third type of intangible. And how do we test for impairment? It is tested for impairment at each reporting unit level. How, where, when, you will never know, because this is specifically related to financial accounting, and I haven't seen any question to that extent that requires you to calculate the goodwill impairment the way we do in professional accounting. So just you need to remember, these are the expenses to be charged against your revenues. We are discussing different types of expenses. So amortization of intangible with limited life, with unlimited life, impairment for goodwill, all these are expenses charged against the revenues. Then we have non-recurring items and changes in accounting standards. First, discontinued operations. Certain segments during the period might have been separated from the business and sold off. It is called discontinued operation. It has to be reported separately under the FASB and ISB. Discontinued operations are segments or operations that have been discontinued and sold off during the period. How is it accounted for? Let's say on 1st of January, to just make things simpler, 2021, we decided to dispose of a certain segment and we sold it off on 30th of June 2021. How is it reported? First of all, this segment would have generated some profit or loss. That profit or loss generated between these two dates, measurement date and phase out date, these are called specific dates. So this profit and loss must be reported separately net of tax. And when the assets related to this segment were disposed of piecemeal, the net gain and loss after tax on disposal of the assets must be reported separately. So in other words, you will have two items to report for your discontinued operation. When the operation ran for the period when we decided to discontinue and when we finally disposed of the assets, any gain and loss after tax, and when we disposed of the individual assets of this discontinued operation, those items or net gain and loss must be reported separately. So this is coming your way. Next, we have unusual infrequent items. Certain items that have that are distinctly different from our normal items on the income statement, like gain on sale of certain asset, long-lived asset, gain on disposal, loss on disposal, certain write-off of your account receivables or writing off your inventory. So such items are unusual because they are not frequent. So what do we do with these? They are reported normally as a part of your continuing operations. Just like your normal expense, salary and administrative expenses, they are reported just like any other expense. No separate treatment. Extraordinary items. Extraordinary items were allowed under the US GAAP till December 2015. After that, this item is now extraordinary items are not allowed under the US GAAP and they were not allowed under the IFRS previously. So in other words, extraordinary items are not allowed. So I won't discuss them further, otherwise they were much more in detail in our CMA financial reporting section. So we don't need to. Extraordinary items, what was the item that is called extraordinary? Item that is infrequent in occurrence and unusual. If they meet both of these criteria, infrequent and unusual, collectively it's called extraordinary item. Here we have unusual or infrequent, but the item that is infrequent and unusual, it is considered extraordinary item, so we just don't need to do it at all. Next, changes in accounting standards. When the accounting standards are revised, new accounting standards keep on coming, like revenue recognition has been replaced. There are many changes in the financial instruments. So revenue recognition standard has been revised, and then further updation in standards are keep on. So whenever there is change in accounting standard, how do we report it? Now, there are three things that need to be understood well. if there has been a change in accounting principle means we have switched from one US GAAP revenue recognition to another one, or one IFRS to another one. This is called change in accounting principle. From one US GAAP to another, one IFRS to another. In such a case, we have to apply this change retrospectively. Means if you have given 2020 financial statement under the old standard and 2021 under the new, you have to revise your prior year financial statement as if the new standard has been applicable from the beginning. So it means when the change in accounting principle is applied, it has to be applied retrospectively. The reported period, both of these reported results must be based upon the new standard, thereby making much easier for you people to analyze, because both are based on the new revenue recognition standard. So changes in accounting principle are to be applied retrospectively. The good thing for accountant is that, for analysts, is that both numbers are on the same basis, so analysis will become much more easier. Then we have changes in accounting estimates. These are applied prospectively. Let's say you had a 5% allowance for provisions for doubtful debts, but in 2021 you took it up to 7%. These are accounting estimates. Change in management judgments. It is applied prospectively. Which means your 2020 numbers and 2021 will be incompatible. So you may have to make adjustment to make them comparable for your analysis. And correction of prior period errors. If there is an error in the previous period that needs correction, it will again be done in a way that requires retrospective treatment. So both financial years will be on the equal basis. So the idea to remember, change in accounting principles, good for you as analysts. Correction of prior period error, good for you, because 2020-21 they are the same, on the same basis. But this might require adjustment because the changes are applied prospectively. The prior year financial statements may have to be adjusted. Next, we have described the financial reporting treatment and analysis of non-recurring items. We have discussed this one previously. Then we have certain expense recognition. Return inwards, also called sales returns. Let's say we have $100,000. This number is being used repeatedly in all our examples. Let's say this is your revenue, and we expect that 2% of the sales might be returned. So $2,000, which there has been no return at all, a zero return. But since our experience tells us that 2% of our sales will return, so we will take an estimated allowance and we will deduct and report our revenue to be 98. This expense will be charged even there has been no sales return, just to apply the matching concept, because 2020 sale cannot be matched against the 2021 return inwards. So this is under the matching concept. Sales current year must be charged against, or must be adjusted against, the expected sales returns, even nothing has been returned by the customer. Same is true for allowance for doubtful debts. A customer, or let's say we have $150,000 of account receivables and we doubt that 2% might not pay. We charge this expense right now in the current year when the sale was made, not in the next period when the actual bad debt was incurred. Right? So return inwards estimated, bad debts estimated, in order to match our current revenues versus current costs. Warranty liability also, if we have given warranty to our customers for a certain period, like for example, when we sell goods for year 1, 2, 3, we provide 3% warranty in first year, 5% second year, 2% third year. This is the estimated warranty expense extended to year 1, 2, 3. Since the sale has been made now, the entire 10% warranty expense must be booked now. If the sale is in 2020, even the warranty expenses being paid in year 1, 2, 3, the whole of it must be charged now. That's the idea. Sales versus expected return inwards now. Account receivables versus expected doubtful debt now. Sales and expected warranty may be extended to 2 or 3 or maybe 10 years. The entire warranty must be charged expense right now to make the matching principle work. The current year revenues must be matched against the expected expenses, even they haven't yet materialized. Keep that idea in mind. Then research and development cost. There are two separate treatments. The research and development cost under the US GAAP, both of these expenses are expensed when incurred. Research cost is incurred specifically to gain some new knowledge. Once that knowledge has been obtained, developing into a viable product is called development. I don't want to go into detail. It's a separate standard. We'll waste our time. So R&D under the US GAAP is expensed when incurred, but under the IFRS, research will be expensed, but development cost must be or can be capitalized if 6 criteria is met. What that criteria is, I won't tell you, because we don't want to discuss financial reporting into that extent. So under IFRS, 6 conditions must be met, and then development cost is capitalized, research is expensed. Whereas in the US GAAP, research and development cost are both expensed when incurred. Next reading is distinguish between the operating and non-operating components of income statement. When you say operating components, mean these are central and ongoing operations of the business from which we keep on receiving our revenues and for which we keep on spending our expenses. So ongoing and central operations, any revenue generated from this and expenses incurred thereon. When you say non-operating, these are peripheral or incidental expenses, peripheral or incidental revenues that are not central and that are not from the main operations of the business. Next reading, describe how earnings per share is calculated and calculate and interpret a company's earning per share, both basic and diluted, for some simple and complex capital structure. This is how we calculate your earning per share. Earning per share is one of the profitability measure ratio, company's profitability performance. Net income minus preferred dividend, sometimes it is called IACS, income available to common stockholders, divided by the weighted average number of shares outstanding. This is the formula we calculate basic earning per share. This is the area. How do we weight? We need to calculate the weighted average. How we give the weights to the shares outstanding. There are some points to remember. Right issue and cash issue, it is considered from the date of issuance. If I have issued right issue or cash issue, they are the similar. Cash issue, in fact, could be right issue. Right issue means that existing shareholders will have the right to purchase the share first. Then they will be offered to the general public. And every right issue is a cash issue. And every cash issue is not a right issue. They're not the same, but they can be. So right issue and cash issue, if the shares are issued on 31st of March 2021 and your year ends at 31st of December 2021, so the period covered under this period will be considered for weightage purposes. Right issue is considered from the date of issuance. Stock dividends, they are applied to all shares outstanding prior to the stock dividend. It means they are given the full weight. Even they might have been issued during the year, maybe partway through the year, they are given full weightage. Reacquired shares, sometimes company purchases on stock from the market called treasury stock. They are excluded from the computation from the date of reacquisition. If you acquired shares on 1st of July 2021, so your period will be considered only these 6 months. Dividends, stock dividends, full 12 months. Even they were issued on 7th month. Right issue and cash issue, they are considered for the period for which they were issued from the date of issuance. Then stock split and reverse split, it is applied to all shares outstanding. Even the split was made on, let's say, October, but the effect of split will be given to all the shares from the earliest reported period. We'll do it. And then shares sold or issued in purchase of assets, they are treated same way as if they were a right issue or cash issue. All this is coming. This we won't do. This is from your CMA, not your CMA, my CMA. And it's quite an extended example which we do for understanding the idea of weightage, how to weight. So just for you guys, stock dividend and stock split, it impacts all the shares outstanding from the earliest reported period. Stock split, stock reverse split, stock dividend, they affect all the shares outstanding. We don't go into this. If we do, it'll take 30 more minutes and we don't have much time available. So distinguish between dilutive and anti-dilutive securities and describe the implication of each for the earnings per share calculations. When you say dilutive securities, these are stock options, warrants, convertible debt, convertible preferred stock that would decrease your EPS if exercised or converted to common stock. These are called dilutive securities. Anti-dilutive would increase EPS if exercised or converted to common stock. So how do we calculate diluted earning per share? The starting would be the same. You will have your IACS called income available to common stockholders or attributable to common stockholders upon the weighted average number of shares. What are the necessary adjustments we may have to make? Let's say we have certain preferred stock that will be converted to common stock. So how many common stock will be converted into conversion from preferred stock to? That will be in the denominator. Since your preferred stock are now in the denominator, converted into common stock, you will save preferred stock dividend. That needs to be added in the numerator. Likewise, if we have convertible bonds, will be converted into share. This will be added in the denominator. Like we have 1,000 bonds, will be converted into 10,000 common stock. So this 10,000 will be reported in the numerator to be added for the diluted earning per share calculation. And the interest saved, since interest is a pre-tax item, dividend is a post-tax item, net income is a post-tax item. So this interest saved will have to be converted into post-tax basis by multiplying it with 1 minus tax. Whenever you multiply an item of revenue or income with 1 minus tax rate, that converts the item into post-tax situation. So post-tax interest saving. And finally, when you might have issued certain options and warrants, so when those options and warrants are exercised, they will become certain number of shares whenever exercised, so they will become a part of denominator as well. So this is your regular EPS, preferred stock converted into common stock, preferred stock dividend saved, convertible debt into your common stock, interest saved after tax, and conversion of your warrants on options will be. We will apply this formula as we proceed. Moving on. This is how do we calculate, let's say if we have to calculate the shares issuable from stock options. So this is what we can do. Quick way to calculate the net increase in common shares for options and warrants. Let's say we have some numbers given. Average market price over the year is AMP, that is 20. Exercise price is 15. And number of common shares that the options and warrants can be converted into is 100,000. So if you just plug in these numbers, so this would be the result which you will add to the denominator of your EPS calculation. We will apply this formula in many questions today as we proceed. So this is the addition in the denominator when the options and warrants are converted. Next reading is convert income statement to common size income statement. Let's say we have two banks to compare. MCB, one of the largest banks in Pakistan, with an American bank. Since the numbers cannot be compared because the size difference is huge, so we can convert these numbers into percentages taking sales as a base. I take sales as a base and express every number given under sales as a percentage of sales. For example, what is general and admin expense? 10,000. 10,000 is what percent of 1.4 million? 0.7%. Other expense and losses, it is what percent of 1.4 million? 0.7. So every number you see is expressed as a percentage of sales. Likewise for the same BlackRock, we take 1.8 million as base and express every number given here till the net profit as a percentage of sales. This is called your common size income statement, vertical one, because we have started from sales and came down. This is called vertical, right? So this is called vertical common size analysis, good for analysis purposes because when we are comparing two businesses of dissimilar size, so converting their financials or income statements into common size will help us a great deal to compare likes with likes. It's much more easy in this case. Okay, so this was, then this is as I said, it's the vertical one where we took sale as a base. There is also horizontal one where we go sideways, where we take, this is our base, let's say this is 2019, 2020 and 2021. We take this year as a base, all these numbers will represent a base. Next year sales 1.4 million is what percent of 1.5 million? 1.8 million sales in current year 2021, it is what percentage of the base year? Likewise, every number, the sale each year is expressed as a percentage of base year sales. Cost of sale each year is expressed as a percentage of base year cost of sales. And likewise, gross profit each year is expressed as a percentage of gross profit of the base year. This is called horizontal common size analysis, right? Then we have evaluate company's financial performance using common size income statement and financial ratios based on the income statement. What do we have now? The ratios. Financial ratios with regard to income statement: gross profit Operating profit and net profit. Gross profit expressed as a percentage of sales is called GP margin. Operating profit expressed as a percentage of sale is called the operating profit margin, and net profit expressed as a percentage of sale is called the net profit margin. These are the numbers given here. Gross profit expressed as a percentage of sales, operating profit expressed as a percentage of sales, and net profit expressed as a percentage of sales. So these ratios, quite straightforward, you might have gone through in your elementary accounting. Next is statement of comprehensive income. Statement of comprehensive income is basically sum of two statements. Your normal income statement that we just discussed, profit and loss account, results of operations, and if we add the other comprehensive income with it, it will become what you call the comprehensive income or statement of comprehensive. This is what we know. We discussed in detail. We have been preparing it repeatedly. What is other comprehensive income? Other comprehensive income contains certain transactions that are so unique and different they cannot be reported in the main body of your income statement. These are the 4 transactions. Loss or gain on defined benefit post-retirement plans. Any gain and loss is not reported in your income statement, reported separately in other comprehensive income. Any gain and loss on foreign currency translation, reported here. Any gain on remeasuring available for sale debt securities. Please mind the word gain on remeasuring available for sale debt securities. It is reported here in OCI. And finally, any effective portion or losses, gain and loss on cash flow hedges. These 4 specific transactions are reported in OCI, and it is added to the net income results to give you the total comprehensive income for the period. There are 2 alternatives allowed in the US GAAP. Either you report your income statement and OCI in 2 separate statements consecutively, or they can be combined into a single continuous statement. But they must be reported side by side in the same place, not in the notes. So that ends your reading, understanding income statements.